I mean, the Air Force will actually know what it is. But unfortunately, the BJP, the subtleties in these arguments do not actually find resonance because it's difficult to explain all these things. So ordinary man doesn't understand. He understands, okay, 550 crores and 1,600, something is missing in the middle. So the BJP has to find an answer there. And I think that's where I think they are failing.
Well, it's a perception battle when it comes to politics. Do you think that voters will think about Rafale when casting their all-important vote in the general elections? Well, this is what all of you said in our online poll. We're going to be back next week with another big issue in the countdown to the general elections. Till then, thank you for joining us.
What started out as a quest for good coffee has turned into a single estate specialty roast coffee connoisseur's paradise.
It was purely, this is something that we want. We're looking for good quality coffee.
Theirs is a story of starting something amazing and new and refreshing.
It wasn't just Matt and me who were taking this journey to change the coffee landscape in India, but it was actually going to start from the farms.
The face of coffee in India has seen a sea change in the last few years. And it's owed now in a small way to Matt and Namrata, the founders of Blue Tokai Coffee Roasters. Watch their exceptional story only on Bloomberg Quint.
This is a demonstration of Wirecast.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
This is a demonstration of Wirecast. This is a demonstration of Wirecast.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. Everyone's a price taker, not a price maker out here. There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that is sustained.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Came to Washington as a Federal Reserve governor and then chaired the Fed from 2006 to 2014. Janet Yellen, after a similarly accomplished academic career at Berkeley, served as a Fed governor, president of the San Francisco Fed, and chair of the central bank from 2014 to 2018. And Jay Powell is a former Treasury official and private equity executive. He has chaired the central bank for the last 11 months. Chair Powell is not an economist, actually. He has a law degree. This does sound like the start of a joke. What happens when a lawyer walks into a conference with 13,000 economists? The punchline is, we're about to find out.
This is a demonstration of Wirecast.
So let's dive in first with you, Chair Powell. Since the December FOMC meeting, it was only 2 weeks ago, shockingly, markets have been volatile. We've seen some real pessimism in some economic surveys. We also saw a blockbuster jobs report this morning. Look, you've been optimistic about the economy. Is that changing? What is your outlook for 2019 and beyond?
Well, thanks very much, Neil. It's great to be here. Also great to be with Janet and Ben, as always. I'll talk a little bit about 2018 and then turn to the outlook, if I may. So 2018, by so many measures, was a good year for the United States economy.
Wirecast.
And most of the hard data that we see coming in remain quite solid and suggest ongoing momentum heading into 2019. You mentioned this morning's jobs report. For those of you who haven't seen it, we had 312,000 payroll jobs added, a very strong number. We have unemployment remaining below 4% for 9 months now, the longest period since the mid-1960s. We have labor force participation picking up again and surprising to the upside, which is very, very welcome. And finally, we have wages, which are continuing to gradually move up. Average hourly earnings moved up, and that's quite welcome. And also, for me at this time, does not raise concerns about too high inflation. So very strong report today. We've also seen, on a more forward-looking basis, we've seen initial claims for unemployment insurance near their historic lows, and so that's more of a leading indicator, and we still see real strength there. Consumer spending has been strong right through December. The reports we're getting from the retail industry suggest continuing spending right through the holiday season. I would say those are all good data points. There is yesterday's Institute for Supply Management report, which came in well below expectations. And I would just provide a little bit of context there. The ISM report is a survey of manufacturing conditions, and it had been at historically high levels, in fact, higher than it had been even in the strong expansion of the late 1990s, and much higher than it had been during much of this expansion. So it's now at a level which is considered consistent with ongoing moderate growth, and is about at the level or even higher than it's been in the earlier years of this recovery. So that's a little bit of context. I would say the fact that it moved down so much in 1 month is something worth keeping an eye on. So notwithstanding that report, though, I would say U.S. data seem to be on track to sustain good momentum into the new year. I'll talk about China for a second. China's been a big part of this story, and the most recent data from China have been more mixed. China's consumers appear to be pulling back, as seen in the Apple News and in the weak retail sales data. The 2 PMI reports we got earlier this week show softening in domestic and external demand, and this weakness seems to be spilling over to other emerging Asian economies and to global commodity prices such as copper, for which China is such a big buyer. That said, Chinese authorities are responding with additional stimulus, and China and the rest of emerging Asia should continue to expand at a still solid pace this year. So overall, I would say the picture for the rest of the world remains consistent with continued growth here in the United States. So good data still, I think, is the story looking in the rearview mirror. But financial markets have been sending different signals of concern about downside risks, about slowing global growth, particularly related to China, about ongoing trade negotiations, about what maybe let's call general policy uncertainty coming out of Washington, and among other factors. So, you know, you do have this, this difference between, on the one hand, strong data and some tension between financial markets that are signaling concern and downside risks. And the question is, with those contrasting sets of factors, how should we think about the outlook and how should we think about monetary policy going forward? Now, when we get conflicting signals, as is not infrequently the case, policy is very much about risk management. And I'll offer a couple of thoughts on that to wrap up. First, as always, there is no preset path for policy.
This is a demonstration of Wirecast.
And particularly with the muted inflation readings that we've seen coming in, we will be patient as we watch to see how the economy evolves. But we're always prepared to shift the stance of policy and to shift it significantly if necessary in order to promote our statutory goals of maximum employment and stable prices. And I'd actually like to point to a recent example when the committee did just that in early 2016. And I mentioned this in this December press conference in passing. As many of you will recall, in December 2015, when we lifted off from the zero lower bound, the median FOMC participant expected 4 rate increases for 2016. But very early in the year, in 2016, financial conditions tightened quite sharply, and under Janet's leadership, the committee nimbly, and I would say flexibly, adjusted our expected rate path. We did eventually raise rates a full year later in December 2016. Meanwhile, the economy weathered a soft patch in the first half of 2016 and then got back on track. And policy, gradual policy normalization resumed. Now, no one knows whether this year will be like 2016, but what I do know is that we will be prepared to adjust policy quickly and flexibly and to use all of our tools to support the economy, should that be appropriate, to keep the expansion on track, to keep the labor market strong, and to keep inflation near 2%. And I will stop there. Thanks.
So Chair Powell, as you note, since the last FOMC meeting, markets have moved in big ways. The 10-year Treasury yield is down a quarter percentage point. The Fed funds futures path is suggesting no rate increases, maybe even rate cuts in 2019. Are the markets telling you that you made a mistake?
I think the markets are pricing in downside risks, is what I think they're doing. And I think they're obviously well ahead of the data, particularly if you look at this morning's labor market data and the other data that I cited. So markets are expressing concerns, again, about global growth in particular. I think that's becoming the main focus, and trade negotiations, which are related to that. And I'll just say that we're listening carefully to that. We're listening with, sensitively to the message that markets are sending. And we're going to be taking those downside risks into account as we make policy going forward.
Now, at your press conference, you affirmed that you intend to allow the balance sheet to continue shrinking at a steady rate. Would you reconsider those plans in light of this flexibility you spoke about a moment ago?
Yeah, so let me talk about the balance sheet. Some years ago, we decided that rate policy was going to be the active policy tool, and that the balance sheet would be allowed to shrink gradually and predictably in the background. And it was supposed to be about as interesting as watching paint dry in Janet's famous locution. So, and that division of labor has served us well, and we think has served the economy well. And so we also said at the very beginning, I think in our original, certainly the first policy normalization plans that I was involved in 2014, we said that we would be prepared to adjust our normalization plans as appropriate to achieve our goals. So if we ever came to the conclusion that any aspect of our normalization plans was somehow interfering with our achievement of our statutory goals, we wouldn't hesitate to change it. And that would include the balance sheet, certainly. So I would say today, of course, we're hearing a lot from different groups of people about the role that the balance sheet normalization may be playing in the markets. I think we are of the view that what really happens mechanically when when our securities mature is Treasury issues a comparable amount of securities, but they do so across the yield curve. The amounts are not that big. They haven't been that big compared to the issuance Treasury is already undertaking. So we don't believe that our issuance is an important part of the story of the market turbulence that began in the fourth quarter last year. But I'll say again, if we reached a different conclusion, we wouldn't hesitate to make a change. If we came to the view that the balance sheet normalization plan or any other aspect of normalization was part of the problem, we wouldn't hesitate to make a change.
So let's broaden our conversation now. Dr. Yellen, if this expansion lasts into next summer, it'll be the longest on record. You played a significant role in making that the case. How confident are you that this economy is on track to keep growing through 2019? How worrying do you find these latest moves in markets and some of the survey data?
Well, I agree with Chair Powell's assessment that he just offered up. The data suggest we have a pretty strong economy. Consumers, consumer spending is 2/3 of all the spending in the economy, with strong job growth and income growth, debt burdens having been reduced substantially, housing prices having risen, oil prices down, putting some money in consumers' pockets. I think consumer spending, and it looks, as Jay said, as though spending over Christmas was strong. That's a strong base for the economy next year.
This is a demonstration of Wirecast.
I don't think that expansions just die of old age. Two things usually end them. One is financial imbalances, and the other is the Fed. And usually when the Fed ends a recession, it ends an expansion, it's because inflation has gotten out of control and the Fed needs to tighten to bring it down. And I think the Fed is now very well positioned with inflation being low and inflation dynamics being favorable in the sense that the linkage, so I believe that there is a linkage between slack in the labor market and product markets and inflation, but the strength of that linkage is not very great. So we have a relatively flat Phillips curve is another way of putting that. And in addition, inflation expectations seem well anchored, and so inflationary dynamics are very favorable. It gives my former colleagues the opportunity to be careful, to move gradually, to be data dependent, to manage the risks, and I have confidence that they'll be able to do that. And I don't really see financial imbalances in the economy at this point that look to be threatening. So, of course, we have had a tightening of financial conditions. Markets are obviously worried about downside risk. There are we are seeing some slowing in the global economy. I believe growth is likely to slow quite a bit next year, but still likely end up being above the growth rate of potential, which is consistent with a strong labor market and maybe even some further tightening.
Dr. Bernanke, you spoke once of a Wile E. Coyote effect as this fiscal stimulus impact of the tax cuts fades, that we might find ourselves in a bad spot over a cliff looking down. Are we looking at that now? Is that part of what's being priced in, and how much is that fear something imminent?
Well, I think we have an excellent chance of breaking the all-time record for an expansion, a 10-year expansion in the middle of next year. It's likely that the economy will grow more slowly in 2019 than in 2018, and maybe even more slowly in 2020. This is not something that is news. I mean, we've anticipated this for a long time because the fiscal policy in particular that was enacted close to a full employment starting point, we knew that barring changes in the law that stimulus was going to be dying down over time, and that's certainly going to be slowing growth, all else equal. Financial conditions were, if anything, a little bit ebullient, in 2017, early 2018. To some extent, what we've seen, this tightening we've seen, is a take back of some of that, particularly with concerns about geopolitical considerations, trade wars, and the like. And then, of course, the sort of perfect confluence of synchronized growth we saw in 2017 is also globally has also been a little bit less strong. So all these things do suggest some moderation. But as Janet says, expansions don't die of old age. I like to say they get murdered instead. And right
just
now,
hope the murderer is not here on stage with us.
right now I don't see anyone's cloaking behind, hiding behind the curtains. But some slowing does seem likely. Let me just say, that it is a good thing that the Fed has the flexibility to respond in a way that will be responsive to the data, responsive to the markets, and that manages the risks that are obviously on both sides of it.
This is a demonstration of Wirecast.
So, as all three of you know all too well, being Federal Reserve Chair is not just about economics. It is about navigating the political system, navigating Washington. That task has become trickier for your successor. Chair Powell, the president seems to be very unhappy with the path of rate increases. There's been reporting that he's considered trying to fire you, which would raise legal questions, to put it mildly. Have you received any direct communication from the White House expressing displeasure? Have you received anything direct from the White House about unhappiness with the path of rates or discussion of any change in your job?
No, no, I've not. I have not. I have no news for you on that.
There's also been discussion of a face-to-face meeting between you and the president. If invited, would you accept that kind of invitation if it were made?
So again, I have no news on that. Nothing's been scheduled. I would say that meetings between presidents and Fed chairs do happen. And
This is a demonstration of
I can't think of any
Wirecast.
Fed chairs who didn't eventually meet with the president. But again, nothing has been scheduled, and I don't really have anything to report on that.
If the president asked you to resign, would you do it?
No.
Dr. Bernanke, you worked under two presidents, President Bush and President Obama. Can we broaden this discussion of the relationship between the Fed chair and the political system? How did your interaction with those two presidents work? When a relationship works well, what happens?
This is a demonstration
Well, I had a very good
of
relationship
Wirecast.
with President Bush, who initially appointed me, and I worked for him in the White House for a time, and also with President Obama, who reappointed me. Both of them were very respectful of the Fed's independence on short-term interest rate decisions. On a few occasions, in fact, President Obama wryly commented to me that he'd been criticized abroad for Fed actions, and he had to tell them, no, it really is not our bailiwick, and that the Federal Reserve is making
QE2 was a difficult time for a lot of us.
So I had a good relationship with both of them, and I think it worked well that the Federal Reserve is, of course, its goals are set by Congress. It is accountable to Congress. The Fed has become more and more transparent over time. I want to congratulate Jay on adding the 4 additional press conferences every year. It's very important that the Fed be accountable and transparent, but it makes the best outcomes occur if the individual interest rate decisions made in pursuit of those mandated objectives are done independently in a nonpartisan way, looking at the long-term goals of the Fed. And I think Jen and I were very lucky that Presidents Bush and Obama were very respectful of that, and I think it worked well. I had a good relationship with the Treasury secretaries, with the other administration officials, and kept them well informed, and had, again, a friendly relationship. So I thought that was an ideal arrangement. During the financial crisis, we had to work, the Fed and the Treasury had to work quite closely on those issues, but I would separate some of those issues from pure monetary policy decisions, which were always left to the discretion of the Fed.
Do you see President Trump's approach as problematic?
Yeah, I think everyone would be better off if it was clear that the Fed is making its decisions based on its mandate and on its assessment of the long-term needs of the economy, which I'm completely confident that it will do.
Dr. Yellen, do you believe that the president weighing in the way he has poses long-term dangers for the Federal Reserve and its independence and sound monetary policy?
Well, I think only if it served ultimately to undermine public confidence in the Fed, in the basis for its actions and its responsiveness to its mandate. It had been a very long tradition. It, I think, began really with President Clinton for presidents not to comment on particular Fed decisions. And I think that helped shore up the independence of the Fed and public confidence that the Fed was acting in a non-political way. And as Ben said, trying to make its best judgments to pursue its congressional mandate. I think that's the best kind of arrangement for a president vis-a-vis the Fed. Obviously, the president has a right to comment on the Fed, but I would worry that if it continues or intensifies, that it could undermine confidence in the Fed and the market's confidence in the Fed's judgments.
Anything to add, or are you?
Sure. No, look, I do want to add something. I want to say that people should know that the Fed has a very strong culture around non-political activity, and we are committed to achieving the goals that the law gives us, and we're committed to doing so in a completely non-political way, based on the best thinking, based on a diversity of perspectives, and we're always going to do that. And it's very much in the DNA of anyone who's spent any time at the Fed. So I would want the public to be assured that we have a strong culture. It's not a fragile one. It's not subject to being disrupted. We will always do things that way, and I would again want people to have confidence in that.
Let's talk a little about kind of the mechanisms of monetary policy. Dr. Bernanke, you spent your academic career looking at ways that at the zero lower bound one could ease monetary policy. It became very real during your chairmanship. Knowing what you know now, what might you do differently during the financial crisis? As we know about these different tools, quantitative easing, forward guidance, credit easing, the various approaches you took, what are the lessons we've learned about what works and what might be useful if we find ourselves in another downturn?
We're talking about monetary policy specifically. Yeah. So, I mean, one of the things we learned was that with long-term interest rates being generally lower around the world, that the risk of hitting the zero lower bound or the slightly negative bound that we see in Europe is a much more salient risk than we thought it was 20 years ago. And so dealing with that situation has become, going forward is a greater risk. We approached it, when we hit zero, we approached it by doing a couple of additional things. One was forward guidance, which was using a language to communication to explain not just what we were doing currently with our rates, but what we would expect to be doing in the future. And then quantitative easing, which was purchases of treasury securities and mortgage-backed securities. I think those things were constructive. Certainly the concerns that some critics expressed that it was going to lead to hyperinflation and many other extreme outcomes was not correct. I think we learned a lot about how to communicate and coordinate those policies. So I think in the future, while I hope that we won't be very frequently in the situation of being at zero short-term interest rates, I think we do have some tools that could be used and that those things will still be in the toolbox. There are further discussions, I don't want to take you too far off track, about could we change the way we approach the target, the policy target, for example, that would make monetary policy more effective at zero interest rates.
I was mentioning state contingent.
Price level targeting or temporary price level targeting are some examples of that. But the Federal Reserve is doing a review currently of its tools and its framework, and I think there'll be some interesting discussions in that context about whether the current inflation targeting framework needs modification, or would there be ways of making monetary policy more effective at zero. But I think overall, I mean, the experience suggests to me that while the zero lower bound is a real constraint and makes it harder to manage monetary policy, there are some tools that can be used in that circumstance to get additional accommodation.
Anything you want to add?
Well, I agree. I think the tools were effective, should remain in the toolkit, and potentially can be strengthened. And I think it's very constructive that the Fed is going to undertake a review. I think one of the things that struck me looking back is that as late as 2012, I believe, you still had long-term interest rates that were around 3.5%. And in a way that reflected the public's view that this would be a short episode, that short rates would go back up more quickly. I mean, it was 7 years that they stayed at zero. And I think we learned things from forward guidance, using them after the financial crisis, that we might be able in a future episode to communicate more quickly the likelihood that rates would stay low for a long time, so that long-term rates would move down more forcefully and quickly. But I think those tools worked.
Chair Powell, anything you can tell us about the Fed's contingency planning if there is a recession during your chairmanship? Do we know which crisis era tools might be brought back? Is there anything you can rule out? How ready is the Fed if things do take a turn for the worse?
Well, as I mentioned, we will use we use all of our tools to the extent appropriate. We'll use the balance sheet. We'll use the tools that we had. And I would agree with what I think both Ben and Janet said, which is that the tools that we used in the crisis after hitting the zero lower bound generally worked. Many raised concerns. I was one who raised concerns when I first got to the Fed, and I said some time ago that the concerns people raised, and it was appropriate to raise them, they didn't really kind of bear fruit. We didn't see high inflation. We didn't see asset bubbles. We didn't see those kinds of things. So, and the real thing is, though, again, I'd echo what Ben said about this conference that we're having this summer. And in fact, we're spending a whole year thinking about this. We're trying to engage with the public, not just the profession, but with the public in general, to explain ourselves a little bit in this era of lower interest rates. How are we going to conduct policy? How are we going to communicate and use our tools in a way that keeps the inflation target credible and that serves the goals that were assigned?
So I want to come back to something you mentioned during your opening comments. So for example, in 2015, 2016, Chair Yellen experienced a time when tighter monetary policy in the United States seemed to tighten financial conditions around the world, slowed growth in emerging markets, created feedback loops that affected the U.S. economy. Some real parallels to what we're seeing now. There are also some parallels to the taper tantrum in 2013, when the signal that QE was not going to go on forever created some feedback loops. I wonder, for those two episodes in each of your chairmanships, can you reflect on the lessons you learned that are relevant for current policy, and what you learned out of that episode that should be internalized as Fed officials work today?
Well, I think looking at risks or feedbacks that come from the global environment, clearly that's an important factor shaping the domestic environment, and it's something that monetary policy needs to take account of. And I think what we saw during that 2015-2016 episode is that U.S. monetary policy ended up having spillovers. And in general, monetary policy does have spillovers to other countries as the Fed raises rates or is expected to raise rates more quickly than those in the rest of the world. Capital tends to be attracted to the U.S. It tends to push up the dollar. It tends to slow global growth, especially for countries, emerging markets with dollar-denominated debt. Both higher interest rates and weaker local currencies raises the burden of that debt, can serve to slow growth in the rest of the world, not necessarily, but may slow growth in the rest of the world. And then there may be feedback that can, in some cases, become quite relevant to the conduct of U.S. monetary policy. And Jay pointed to this in his opening remarks. Certainly 2016 was an example of a situation where linkages from U.S. monetary policy to global financial conditions and growth and back again, spillbacks to the U.S. outlook, did lead to a significant revision of what the appropriate path of policy should be. And we ended up, as Jay said, in December of 2015, when we first raised rates, the median in the projections of the committee participants, they were looking for 4 rate increases during 2016. And these feedback loops were sufficiently strong that we ended up raising rates only once. And I don't have regrets about that. Sometimes it's difficult to predict how these things will play out, and that's why data dependence and being amenable to changing one's view if risks seem to be feeding back to the U.S. outlook, why that's an appropriate way to proceed.
Dr. Bernanke, the taper tantrum?
Well, so first in general, clearly what the Fed does has a big effect globally. The dollar is the international currency, so even when third countries trade with each other, often the invoices of the trade are in dollars, and international borrowing and lending is typically in dollars. And so we recognize that those effects are powerful, and they do feed back on the U.S. economy. We took seriously in the crisis, in particular, our role as global lender of last resort. The Fed got far less attention than some of the other things that we did during the crisis, but we conducted currency swaps with 14 central banks, including 4 emerging market central banks, to make sure they had access to dollars to help manage the shortages of dollars globally. And so we served, in some sense, as a global lender of last resort. So we were quite aware of these international factors. The taper tantrum, I think this is an example of where in the future we might do better. I think there was communication concern there in that when we announced a contingent and very gradual slowdown in our purchases, I think it wasn't so much that slowdown as it was the inference that was taken in some quarters that this meant an imminent increase in short-term interest rates. And we saw, the forward curves shifting up immediately, even in other currencies. And so it just shows you the subtlety of how these different tools interact. One of the roles of asset purchases is to offer a signal about where future rate policy is going to be. And so I think what happened in that episode was that again, there was an inference taken that policy rates were going to go up much more quickly than we intended. And we tried to be very clear about that. We tried to clarify that. I think in the end, the message came through, and the effects, at least in the U.S. economy, turned out to be pretty minimal. But we learned, and future central bankers will understand the importance of coordinating the communications across the different elements of monetary policy, in this case between asset purchases and rate guidance.
Chair Powell, you were a governor during both of these episodes. As you sit in this chair now, part of this is the cost of being a global reserve currency. It makes your job more complicated. What lessons do you draw as you set policy over the months ahead?
Well, a couple of things. First, the taper tantrum left scars on anybody who was working at the Fed at that time. And I think the takeaway was that the market could be very sensitive to news about the balance sheet, to the pace of normalization, anything like that. That's one of the reasons why the balance sheet is supposed to be in the background, gradual and predictable paint drying, as opposed to the active tool. We didn't want to have 2 active tools going at once, so that was one of the things. Another takeaway, I agree with everything that Ben and Janet said. Another takeaway is, particularly after the taper tantrum, there was a great deal of back and forth over, do other countries have even freedom of monetary policy and that sort of thing. And I think so. A lot of research has been done, and much of it by Fed people. And the sense of it is that the best thing that we can do, I think, is to be as transparent and predictable as possible, and that a strong U.S. economy is good for the world, and that sometimes the role of the U.S. monetary policy in other countries is exaggerated. Notwithstanding that, sometimes there's a real effect, and it helps. If you're a small open economy, you can address some of that with strong institutions, in particular with floating exchange rate.
Turn to something else. An argument that I've heard people wrestling with recently goes like this. For much of the post-Volcker rate moderation era, the Fed has been very successful at keeping inflation low, but often at the cost of tightening monetary policy and putting the brakes on the economy whenever the job market is starting to get hot and unemployment gets very low. That this has the effect of helping asset prices as during periods of easy money, but then essentially taking things away and not letting the economy heat up enough to really benefit workers and labor when things are going well. The idea is that this is contributing to lack of bargaining power by labor, that this is part of the declining labor share of national income and inequality. Dr. Yellen, you've been part of the Fed for longer than the others here. Is it a valid critique? Do you worry that there's been a systematic willingness to let asset prices rise but not worry as much about labor market outcomes?
Well, I think in the aftermath of the financial crisis, we've been totally focused on employment outcomes and willing to, in a way, take a data-dependent approach and have an open mind about where the economy could go without generating, of course, it's a dual mandate, maximum employment and price stability. Issues of where will inflation begin to set in the face of labor market tightness. What is the natural rate of unemployment? Members of the FOMC have learned a lot about that over time. They have revised their views. One of the things we've seen, and actually this was an aspect of today's report, is although unemployment is historically low, we haven't had this low an unemployment rate in, it's close to 50 years. We were uncertain just how much scope there was for labor force participation to contribute to employment growth and to ease pressures that would otherwise be inflationary. And we've, in a way, been able to see very strong job growth and historically low unemployment rates because it's really not turned out to be inflationary, and labor force participation has continued to increase. So certainly I don't think that's a fair criticism. That's been a very strong focus of the Fed.
You mentioned, Chair Powell, the wage growth we saw in this morning's jobs report. You mentioned in your Jackson Hole speech not being, well, I don't, put in your words, how much should we trust estimates of the natural rate of unemployment? How much should we say this is a job market that isn't creating huge inflation yet, let's let it run and see where this leads?
So we need the concept of the natural rate of unemployment because we need to know whether employment is, we need to have some sense of whether employment is high, low, or just right unemployment. But we have to understand that it's, you know, that there's tremendous uncertainty around the actual location of it. And we are in an era where inflation dynamics are such that the relationship between slack and changes in slack and inflation, changes in inflation, is very weak, but it's still there. It's clearly still there in just about all the research that's been done. So I think we've been willing to revisit our views, very much willing to revisit our views of what the natural rate is, and also our understanding of what it is. So you know, if you look at the forecasts of FOMC participants, we have unemployment remaining below 4% through the entire projection period, and you have inflation remaining right around 2%. So we're not acting on it as though it were some certain number. We're very much, I think we're very open-minded about both what the level of the natural rate is and also what the implications are for inflation. I think it would go too far to just ignore resource constraints completely, because we can get the old inflation dynamics back over time if we want to, where there was a very strong relationship between changes in slack and inflation. But I think that's the way I would think about it.
How about this linkage? Part of the traditional Phillips curve relationship is low unemployment creates a tight labor market, wage pressures, which flows through to broader inflation. There's two steps there. There's tight labor market to higher wages to overall inflation, and that's the linkage we haven't seen as much of lately. How do you think of that?
Both of those links have weakened significantly since we were young, since the 1960s, since I was young anyway. Before you were born.
This is a demonstration of
so they've weakened a lot, and I've mentioned, you know, we had wages going up faster than productivity plus inflation during the latter part of the 1990s expansion without having price inflation. So there's the link between the two, between wage inflation and price inflation, is pretty weak, and you know, wages going up is not necessarily inflationary, and we know that very well. I mean, I think we have inflation under 4%. Sorry, unemployment under 4% for 9 months now.
This is a
we have inflation under control,
Wirecast.
and I think that's a pretty good outcome, and we sure think it can continue.
Dr. Bernanke, is the Phillips curve dead or just really flat and really uncertain?
So to use a slang economics jargon, this is an endogenous phenomenon. Chairman Volcker and Greenspan did the three of us a big favor by bringing inflation under control and helping to anchor inflation expectations very closely to roughly 2%, and we formalized that target, I think, in 2012.
This is a demonstration of Wirecast.
Janet and I were, in our terms, were very supportive of economic growth and employment. This was a critically important objective for us, but it was very helpful that inflation expectations were so well anchored, and it gave us flexibility, the ability to take very stimulative steps without worrying that inflation expectations would drift off and that inflation would become an immediate problem. So that's sort of a capital asset that central banks have, that inflation expectations are so well anchored and stable. And that's the, quote, endogenous reason why the Phillips curve is so flat. That allows us, and Jay, to be, to explore the range of, how far unemployment can decline and to be aggressive at times when necessary. But ultimately, you want to protect that capital asset. You also don't want to allow inflation to persistently deviate from, the target area because of the cost that, if you did unanchor inflation expectations, which I don't expect to happen, that would be costly in terms of your ability in the future to stabilize the economy.
Under Dr. Yellen on regulation, a real emphasis of the Fed since the crisis has been macroprudential regulation, the idea of regulating the financial system, accounting for risks to the macroeconomy. How confident are you that the financial system we now have will prove resilient? Is there anything you would like to see the current Fed or other regulators do to strengthen that capacity?
Well, I think a lot's been accomplished, and the financial system is definitely in better shape. There's more capital, higher quality capital. The institution of stress tests is a very important supervisory innovation, maybe the most important in terms of aiding public understanding of what's happening in systemically important banks and encouraging better risk management in those banks. Derivatives are safer, many now that are standardized or centrally cleared. There are much higher margin requirements on those that are not centrally cleared. There's been money market reform. So a lot of things have happened that I think have left us with a safer financial system. That said, I'd say it's a work in progress, and there is more work to be done. I worry about the fact you said macroprudential tools. I actually think in the United States we have a shortage of macroprudential tools. So while we've made the system year in and year out more resilient, if we were to see a threat like house prices rising, we're concerned that a bubble is developing. Many countries have tools that a financial stability board could invoke. They wouldn't be invoked because anyone's worried about the safety of a particular banking institution. The concern would be that escalating house prices and the potential for a collapse could cause a deep and long recession. And many countries, for example, would raise, put caps on loan-to-value ratios and lending.
Canada's been doing some of this.
Right, and there are lots of countries, a lot of Asian countries are doing that as well. The Bank of England has tools as well that they've used. We actually don't have such tools in the United States, and that worries me. And although the Fed got new tools, if there were a problem in a systemic institution that would help to resolve a systemically important non-bank, say an investment banking sub of a bank holding company, we've lost some of the emergency lending powers that were used during the downturn, for example, to support AIG, whose collapse, I think, would have been disastrous at the time. So I do have some concerns.
Chair Powell, do you believe you have the tools you need to deal with financial systemic risk?
Well, I would agree with Janet that we don't have a lot of tools that we can move around as a cyclical matter. So we've had to make up for that by having through the cycle macroprudential policies, and I would characterize the stress test, particularly for the largest institutions, the stress test and also the very high capital requirements and liquidity requirements and resolution requirements that we have on the most systemically important. So those are through the cycle measures which are always on. I think we're not strong in terms of having tools that we can turn off and on. And frankly, that's just a fact of life for us. I think that there's a long history of and not a happy history of trying to use things like loan-to-value ratios. They don't survive very well. The other thing about the United States, of course, is that most credit intermediation takes place in the financial markets, not the regulated, supervised banking system. And that's That's just a different thing. You know, it's not the financial capital markets are not prudentially regulated. It's completely different, and it's a real strength from a capital raising and dynamism standpoint. But it's something, you know, something we've worked on a lot, and I think that, you know, I think what we've done with the banks is a good body of work, and I feel good about where the banks are. And I also feel fine about the capital markets, but I think there's more to be done in central clearing, for example, and there's more to be done in the capital markets generally.
This is a demonstration.
If I could step away from economic policy for a moment to talk about the economics profession. Dr. Bernanke, you become president of AEA later today. Dr. Yellen, you take over that job a year from now. My colleagues Jim Tankersley and Ben Castleman have reported on accusations of harassment and abusive behavior by Roland Fryer at Harvard. They tell me they've received many tips about bad behavior by other senior economists at leading universities since that story was published. My question for both of you is this: what more needs to happen to ensure the economics profession is welcoming to all types of people, that abusive behavior isn't tolerated? And what more can AEA and other institutions and universities themselves be doing to make that the case?
Well, economics certainly has a problem. We have a very low ratio of women in terms of our professional ranks, and unfortunately, a reputation for hostility towards women and minorities seems to be an important reason why many women choose not to become economists. That's bad for them, and it's bad for the profession because we're losing a major source of talent and insight. As you mentioned, I'm becoming the president of the American Economic Association. Janet will follow me. We work together on this. I think this should be our top priority. We are currently, the AEA is currently conducting a survey of its membership on professional climate, asking people to report things that have happened to them in general or specifically. AEA members here or who are listening, if you haven't filled out your survey, please do that. That will help. That information will help us think about next steps. But I think, in general, we've got to work much harder to increase women's participation in economics. A small example of that is that I appointed a 19-person committee to pick all the papers and sessions that are in the Atlanta meetings here. 11 of the 19 are female, and I hope that will add perspective to these meetings. We've also introduced a new website for job market discussions, which is intended to make it unnecessary to go to a private sector website that had a lot of bad reputation in terms of misogynistic comments and so on. And we're going to continue our efforts to mentor young women and minorities at the college level, graduate level, and up the chain. Unfortunately, this is a long pipeline. It takes a long time to transform an interested undergraduate into a senior professor. But we are very committed to this. I'm sure Janet will want to add to this, but I think it's very important for economics that we change the equilibrium here, that we change the perception of economics as being unfriendly to any group of people.
This is a demonstration of
Well,
Wirecast.
I agree. I'm very supportive. I agree this should be the highest priority for us over the next couple of years. The AEA has formed a new committee to focus on initiatives that might be successful in improving the environment for women and I think and minorities, and I think this climate survey perhaps will be something that can provide useful feedback to individual economics departments about how they compare to their climate to the profession as a whole. I think this committee will look at best practices that departments can put in place to try to improve the climate generally for women and try to come up with a broad array. There has been the adoption recently of a code of conduct for economists that focuses on the importance of diversity.
This is a
Chair Powell, you may employ more
Wirecast.
PhD economists than anyone. How's the Fed thinking of these issues?
Yeah, so the Fed is an important institution in the economics profession and in the country. And so I very much want to follow in Janet and Ben's footsteps and say that diversity and inclusion is a top priority for us. The kind of behavior that we read about is totally unacceptable and will not be tolerated at the Fed. We're committed to a diverse and inclusive
This is a demonstration of
environment. I really
Wirecast.
strongly believe that diverse perspectives are not only do you get better results, but you'll, the young people coming up are accustomed to diverse and inclusive environments, and they're going to want to work at places like that. So part of our business model is to attract the young talent. I want the Fed to be known within the economics profession as a great place for women and minorities and other diverse people to work and be happy and be listened to.
So, Dr. Bernanke and Yellen, you both had excellent academic careers, and you both made decisions to move into public service at various stages. I think in the standard, you get a PhD, you go to university, you try and get tenure. That is not the usual stepping stone. Can you reflect on what role public service played in your own career, your own evolution, and what you would recommend to younger scholars out there trying to decide, should I try and do a year at CEA? Should I do a fellowship at the Fed, something like that?
Well, it was something that figured in my thinking as something I'd like to have as part of my career from my undergraduate days. It was a motivation for me to study economics. I hoped that I would have a chance to serve at the Fed, to serve at the Council of Economic Advisors. I've always seen economics as a body of understanding and of work that is highly relevant to the design of public policy, and felt that economists can contribute to making the world a better and more successful place by helping to apply that knowledge. So it's something I always wanted to do, and it was part of my motivation. And I think as I've gone back and forth between academia and public policy jobs, I found that the knowledge I've gained in academia, the sort of systematic way of analyzing data and thinking about how the world works, is highly relevant in designing public policy. And what one learns in policy jobs then is tremendously enriching in terms of one's research. That spending a year at the CEA or longer, or serving at the Fed, alerts you to interesting problems that you may not have been aware of, and can really enrich one's research. And so there are benefits flowing in both directions.
What are some of the insights you think you got from working in the policy world that helped make you a better academic, a better researcher?
I mean, it's a question of what problems should one work on. And, I think in that regard, I always think about the fact that the Fed, in the run-up to the financial crisis and